A company can make more money than ever before in its history, and its stock can still crash the very same day. Meanwhile, a company can lose money for 10 straight years, and its stock can soar into the stratosphere. If that sounds backwards, that's because almost nobody explains what you're actually buying when you own a stock. It isn't a piece of paper. It isn't a number on an app. It's something far stranger and far more powerful than most beginners ever realize. By the end of this video, you'll understand exactly what ownership really means in the stock market, why some companies pay you just for holding their stock while others never do, and why the price on your screen is telling you a story that has almost nothing to do with cash in a vault. Let's open the vault. Every day, trillions of dollars move through stock markets around the world. Pension funds, retirement accounts, and personal savings are quietly tied to this system, whether people realize it or not. But here's the part that trips up almost every beginner. Buying a stock isn't like buying a product. You're not paying for something to use. You're paying for a claim, a legal claim on a piece of a business and everything it might become. That single idea changes everything about how the stock market actually behaves. And to understand it, we need to go back to a moment when ownership itself was invented. Imagine a bakery in a small town, run by one family for generations. The bakery is worth something: its ovens, its recipes, its loyal customers, its future profits. Now imagine that family decides to sell off small pieces of that bakery to raise money for a second location. Each piece represents a sliver of ownership. Anyone holding one of those pieces technically owns part of the bakery, part of its ovens, part of its recipes, and most importantly, part of its future profits. That's exactly what a share of stock is. Not a certificate. Not a symbol. A legal slice of ownership in a real business. This means when you buy a share of a company, you're not simply hoping the number goes up. You're becoming a tiny partial owner of every store, every factory, every product line that company operates. But ownership brings an immediate question. If you own part of the profits, how exactly do you receive them? And here's where things get surprisingly divided, because not every company treats its owners the same way. Picture two farmers, each managing an orchard of 1,000 trees. The first farmer harvests the fruit every single season and hands a share of it directly to everyone who owns a tree. This is exactly how dividends work. Certain companies, often older and more established ones, distribute a portion of their profits directly to shareholders on a regular schedule, simply as a reward for ownership. The second farmer does something completely different. Instead of harvesting fruit for the owners, this farmer takes every bit of profit and plants new trees, expanding the orchard year after year. No fruit reaches the owners directly, but the entire forest becomes more valuable over time. This second approach describes companies like Amazon for most of its history, choosing to reinvest profits into warehouses, technology, and expansion rather than paying shareholders directly. The bet isn't on harvesting today. It's on owning a much bigger forest tomorrow. Neither farmer is wrong. They're simply playing different games. One rewards patience with steady fruit. The other rewards patience with a bigger, more valuable forest, assuming that forest actually grows the way investors hope. But there's a third option most beginners have never even heard of, and it might be the strangest one of all. Imagine the second orchard grows so large and so profitable that the farmer has more cash than new trees to plant. Instead of paying fruit to every owner, the farmer starts quietly buying back small plots of the orchard from existing owners. Here's the twist. Every time a plot is bought back, the remaining owners each end up owning a slightly bigger percentage of what's left. This is called a stock buyback, and companies like Apple have used this strategy on a massive scale, spending enormous amounts of cash over the years repurchasing their own shares from the open market. The effect is subtle but powerful. Fewer shares exist, so each remaining share represents a slightly larger slice of the company. It's not free money appearing from nowhere. It's the size of your slice quietly growing while the size of the pie stays roughly the same. This is exactly the opposite of something else that happens in the stock market, something that can quietly work against ownership instead of for it. And once you understand this next concept, you'll never look at a company's stock announcements the same way again. Now picture the opposite scenario. Instead of buying back plots of land, the farmer decides to sell brand new plots to raise more cash, perhaps to fund an ambitious new project. New owners join in. But here's the catch. The orchard itself didn't get any bigger overnight. It's still the same size, just now divided among more owners. This is called dilution, and it happens when a company issues new shares, increasing the total number of ownership slices without necessarily increasing the total value of the business right away. Existing shareholders don't lose their trees. But each tree now represents a smaller percentage of the whole orchard than it did before. This single mechanic explains why a company can announce record-breaking growth plans and still watch existing shareholders grow uneasy. More owners sometimes mean smaller slices, at least until the new investment pays off. So now we have four forces quietly pulling on the value of a single share. Dividends handing out fruit. Reinvestment growing the forest. Buybacks shrinking the number of slices. Dilution increasing them. But none of this explains the biggest mystery of all. Why does the price of a share swing wildly, sometimes within minutes, even when none of these four things just happened? Here's where things become genuinely strange. A company's ovens don't multiply overnight. Its employees don't vanish in an afternoon. Yet its stock price can jump or crash dramatically within hours, sometimes over a single sentence in a news report. The reason is that a stock price isn't really measuring what a company owns right now. It's measuring what millions of people collectively believe that company will be worth in the future. Consider this. In 2011, Netflix's stock price collapsed by more than 75% within months after the company announced a controversial pricing and streaming split. The company hadn't lost its movies, its shows, or its technology. What it lost, almost overnight, was investor confidence in its future direction. Years later, that same company would go on to dominate global streaming, proving that a temporary collapse in belief doesn't always predict what happens next. This reveals something crucial about owning a stock. You're not simply buying a company's current assets. You're buying a claim on an unpredictable, ever-shifting story about its future, one that can change directions overnight based on decisions, competition, or even public perception. But if price is just belief about the future, how does anyone even attempt to measure what a company is actually worth today? This is where the story takes an unexpected turn into pure mathematics. Every publicly traded company has something called a market capitalization, or market cap for short. It's calculated by taking the price of a single share and multiplying it by the total number of shares that exist. Here's a strange result of that formula. Two companies can have wildly different stock prices, yet be worth almost exactly the same amount overall, simply because one company divided itself into far more shares than the other. This is exactly why comparing companies by stock price alone is misleading. A stock priced at $10 isn't automatically cheaper than one priced at $500. What actually matters is the total value of the company divided among however many slices it happens to have. Berkshire Hathaway, the company run by legendary investor Warren Buffett, took this concept to an extreme. For decades, it refused to split its shares into smaller, more affordable pieces, allowing its Class A stock price to climb into the hundreds of thousands of dollars per share, all while representing ownership in a business worth hundreds of billions of dollars overall. Meanwhile, other companies split their shares constantly, keeping prices low and accessible to everyday investors, without changing the actual value of the business itself whatsoever. This tells us something essential. A share price by itself means almost nothing. Ownership economics only makes sense when you understand what that price represents, and how many total slices exist to divide the value among. But understanding value is only half of the equation. The other half is far more uncomfortable, and it's the reason so many beginners lose money without understanding why. Owning a slice of a business doesn't just come with potential reward. It comes with risk, and that risk is inseparable from the reward itself. Unlike a savings account, a stock has no guaranteed return. The value of your ownership can rise for years and then fall sharply within days, driven by economic storms, industry shifts, or sudden changes in investor confidence. This is the trade-off at the very heart of stock ownership. Businesses that offer higher potential growth typically come with higher potential volatility, while businesses that offer steady, predictable returns typically grow more slowly. There's also a hidden cost that almost nobody talks about, called opportunity cost. Every dollar placed into one company is a dollar that can't be placed somewhere else at the same time. If you own a slice of one orchard, you can't simultaneously own that same dollar's worth of a different orchard growing somewhere else. This is why long-term investors talk so often about patience. Historically, ownership in growing businesses has tended to reward those willing to hold through storms rather than those chasing quick harvests. But patience doesn't guarantee an outcome. It simply changes the odds over a longer period of time. And this brings us to the final piece of the puzzle, the one force that quietly transforms small ownership stakes into something dramatically larger over time. Imagine a single snowball rolling down a long, snow-covered hill. At first, it barely grows. But as it rolls, it picks up more snow, and that added snow helps it pick up even more snow, faster and faster, the further it travels. This is compounding, and it's one of the most powerful forces in the entire economics of ownership. When dividends are reinvested back into buying even more shares, and those additional shares eventually generate their own dividends, ownership can grow far faster over long stretches of time than it would through a single lump sum sitting still. This explains why so many discussions about stock ownership focus on decades rather than days. The snowball effect requires time to build momentum. Cut the hill short, and the snowball barely grows at all. But compounding isn't magic, and it isn't guaranteed. It only works if the underlying business continues generating real profits over time. A snowball rolling over bare, rocky ground doesn't grow. It simply falls apart. So let's return to that opening mystery. Why can a profitable company crash while an unprofitable one soars? Because owning a stock was never simply about a company's current profits. It's about a claim on an unpredictable future, shaped by reinvestment, buybacks, dilution, collective belief, and the slow, patient mathematics of compounding over time. Understanding this doesn't tell you which stock to buy, or when to buy it. But it does reveal something far more valuable. What you're actually holding when you own a piece of a company, and why its value can shift for reasons that have almost nothing to do with the number flashing on your screen. So here's a question worth thinking about. If a share's price is really just a reflection of collective belief about the future, and that belief can be wrong just as easily as it can be right, what does true ownership actually mean to you? Let us know what you think in the comments.